Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Asian stocks and bonds under pressure after another week sale of treasuries drags down Wall Street. The Fed's Beige Book points to modest growth in the US economy. Saudi Aramco is set to launch a $10 billion share offering in oil giant Aramco. Informal interest is said to exceed the offer amount already. Plus, deal abandoned. BHP walks away from its bid for Anglo American, leaving the world's biggest miner to look elsewhere to expand copper production. Well, good morning. Welcome to Thursday. It has been another weak Treasury auction, knocking stocks, knocking bonds yesterday, just at the moment when the Fed is in no hurry to cut interest rates. Will the growth and inflation data reinforce the view that there'll be no cuts from the Fed this summer? We'll bring you both of them before the week's out. But looking to futures on both sides of the pond, pointing lower this morning. We also had that German inflation data muddying the waters potentially for the ECB next week. And we'll dig into that with Oliver Crook later in the programme. But if we flip over to the cross-asset picture, you can see the impact in the Treasury market of that weak auction yesterday. If we look to the yields, you've got the 2-year at 4.97 currently, and higher yields also drove the dollar higher at the expense of Asian currencies yesterday. Could we see dollar yen topping 160 again? We'll come to that with Avril Hong in a moment, but Brent trading at $83 a barrel, 0.2% weaker as we look ahead to the OPEC Plus meeting on Sunday, where we'll get more info on supply. And finally, gold there checking in at $2,334 an ounce, a touch weaker as well, down 0.1%. But let's dig into the Asian markets now. Avril Hong standing by for us in Singapore. Avril, what's happening where you are?
Yeah, Lizzie, we're seeing it risk off in the region, whether you're talking stocks, bonds, or currencies. As one of our MLive colleagues put it really well, it's a bit of a triple whammy for Asia's assets as we got higher yields, but also weakness coming through in the Japanese as well as Chinese currencies. So EM's particularly hard hit today. Take a look at how the South Korean benchmark Kospi is faring, 1.5% down. It is leading declines now, but the Japanese benchmark not faring that much better. There is a couple of interesting dynamics at play here because we are seeing those higher yields domestically in Japan, sapping appetite for growth stocks in the Nikkei. But that higher yield environment also seems to be drawing in more bond investors. Today, we saw a 2-year auction seeing higher bid to cover ratio than the previous round. Pretty solid, all things considered. So after that auction, we actually saw some recovery in the Japanese 10-year yields. Now, the Japanese currency is also recovering towards that 157 level, pulling further away from what we saw overnight, 157.7, which is well above what was thought to have last drawn intervention from Japanese authorities. And yes, our colleagues at MLive also say 160 might be the next line in the sand level to watch. Let's flip the board because I wanted to talk you through what we're seeing among the tech names in the Asia Pacific as well. They're tracking what we saw among their US counterparts. In general, tech not doing well today. The Hang Seng Tech, this is a gauge of the Chinese tech names, is sliding for yet another session. And if you consider its performance since its peak earlier this month, it is about 9% down. So we are on watch for a technical correction. And this turn in sentiment is interesting because in April, the Chinese tech names were actually behind the rebound in the Hang Seng. But there's been a bit of a shift since they've come through with their AI offerings. There's a price war underway. Geopolitics also weighing on sentiment of these group of stocks. So that is down. Chinese chip names, the other one that I wanted to highlight, because we are seeing a bit of a lift coming through, potentially because of that labor union strike that's coming through from Samsung. It's unclear whether that strike is going to mean any disruption for supply chains, but there could still be a bit of a boost for these onshore chip makers. So that's what we're seeing in stocks. Let's flip the board and take a closer look at what we're seeing on the Chinese yuan, because as I say, say. It is that weakness that's been coming through, and we are actually seeing on the onshore rate, it is approaching the upper limit of that trading band, which is what the PBOC allows. So today there were some slight expectations we might get a bit of a stronger fix. That's not what we got. Second day in a row where we saw a weak fix on the yuan from the PBOC, but as some analysts have been pointing out, it's not like it's letting the yuan go. It's more to account for demand of foreign FX, including the dollar. Lizzie.
Okay, so the effects of that Treasury auction rippling across global markets into Asia. Love how you wear red for risk-off days, April. That's April Hong in Singapore. Well, we can dig deeper into that Treasury auction now. Another weak sale, really reinforcing concerns about the impact of higher yields. And it comes just after the Fed's Beige Book pointed to modest growth, with consumers pushing back against higher prices. Bloomberg's Jill Deesis joins us now for more. Jill, just talk us through how other markets have reacted to this lackluster demand for debt. I'm kind of wondering whether we're going to see a bit of a reversal post-PCE tomorrow.
Yeah, really, Lizzie. I mean, I think as Avril just outlined there, it's been, something of a sour mood. This is now the third straight, sale here where you've seen this lackluster demand. I think, really sort of spilling over into markets there and creating this, sort of these concerns about yields trending higher. I mean, as you mentioned earlier, the yield on those policy-sensitive 2-year notes trending toward 4.9% almost hits that psychological level of 5%, been the highest since earlier this month. So I think really kind of, illustrates a lot of these concerns that are happening in the market right now, these concerns about this, swelling supply of sovereign debt. We'll see whether that PCE reading ultimately changes the picture tomorrow. But yeah, I mean, the Beige Book the results that we've seen so far do indicate that, we're still seeing at least some moderate level of growth there in the economy in the U.S. right now.
Yeah, we also heard from Raphael Bostic saying that he's hopeful price pressures will normalise. You mentioned the Beige Book. Did he get much reassurance from the data?
Well, Lizzie, I mean, I think, you've got some moderate growth. You've got consumers pushing back against price pressures a little bit, I think was really one of those key takeaways that we saw in that data so far. I mean, you're still seeing, sort of an upward trend, but at the same time, you're not seeing, I think, any indication that we've got, the rapid acceleration. So maybe there's some reassurance there for Bostic. But I think that as we've been hearing from Fed officials over the last couple of weeks, what you really want to see is a prolonged trend of cooling inflation for Fed officials to really be happy. I mean, at this point, they want to see, some more cooling in that PCE gauge. They want to see at least several consecutive months of that, sort of cooling in this inflation data before they're actually ready to, cut interest rates. I think it's still, safe to say that at this point, we need more data to actually give us a fuller picture.
All right, Bloomberg's Jill Deesis, we thank you for that analysis as we look ahead to the data today and tomorrow. Of course, the Fed's crucial inflation gauge, PCE, coming tomorrow. But let's get back to politics, specifically in South Africa, set to be the tightest election since the ruling ANC came to power in 1994. Votes being counted in this election, and the Commission saying that turnout looks like it was higher than at the previous election. Jennifer Abasaja has been all across this vote, and we can go to her now. Jen, good morning. Why did vote counting start so late?
Right, Lizzie, good morning to you. I mean, if we take a look at where counting was at when polls were closing, there were still hundreds of people still in line at polling stations across the country. So that's part of the reason now we're still seeing vote counting taking longer than it did in 2019. We also heard from the Independent Electoral Commission, and they're saying that there was a last-minute push, mainly in urban areas, and potentially higher voter turnout that could have contributed to this late voting count. There were also some reports about potentially network glitches that were causing some delays. But, all throughout the day, if we take a look at a lot of the images that we were seeing, people were in long queues, hundreds of thousands of people across the country. There's more than 23,000 voting sites across South Africa. And at this point in time, just over 218 have actually been counted. So we have a bit of a ways to go until we can get some official numbers.
Well, we're all on the edge of our seats. When can we start expecting the projections?
Right. So right now, it's just under 1% of votes that have been counted. I mentioned that 218 number. What we're really waiting for is that percentage, that 5% percentage of votes counted, because that is when we will actually hear from the official Electoral Commission about where projections are at this point in time and give us maybe some indications. But as you mentioned, what we are hearing from the Electoral Commission at this point is that, yes, voter turnout exceeded what we saw, either matched or exceeded what we saw in 2019. They're expecting it to be over 66% potentially. And so that would be a win in some cases, but also, we need to see really when we get those official numbers, what the voting actually looks like, how it matches out.
OK, we'll come straight back to you when we get those numbers. Jennifer Sabasaja, we thank you for being across that election for us. But in the meantime, we've got plenty more coming up today on the docket. We have at 9 a.m. London time the latest European confidence surveys, the expectation being that they're going to tick up slightly across services, industry and economic readings. Then at 1:30 p.m. UK time, we have the second reading of first quarter US GDP. That's expected to be revised lower, which in turn suggests momentum's faded across various areas of economic growth. And also at 1:30 p.m. London time, we get US jobless claims. They're expected to have ticked up at the end of May, but still bouncing around at historically low levels. But you can get a roundup of the stories that you need to know to get your day going in today's edition of the Daybreak newsletter. Just go to DAYB Go on your terminal to find it. Today, they are leading on the Bloomberg scoop out of the Middle East, which is that Saudi is preparing to launch a second offering of shares in Aramco. This could come as soon as Sunday, and we're going to bring you more on that next with Jumana Basechi, who is in Dubai, our Horizons anchor, with all the details on that story. But coming up, we are going to be looking at one of the most exciting UK tech startups and how it thinks about the general election. We'll be speaking to the CEO of Buy Now, Pay Later platform Zilch. That conversation at 6:40 a.m. London time. So stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. It's just coming up to 6:15 a.m. here in London, and let's get you the latest banking news. HSBC is on the hunt for private bankers to expand its Middle East business. The British lender added 100 bankers in 2023 to cater to the number of millionaires and billionaires that's growing and moving to the region. Credit Suisse veteran Aladdin Hangari joined the bank last year to lead the growing Middle East and Africa division. And elsewhere in the Middle East, Bloomberg understands that Saudi Arabia is planning to formally launch a secondary offering of shares in oil giant Aramco. This could come in the next few days, and it could raise more than $10 billion. Well, Bloomberg's Horizons anchor, Jumana Basechi, is with us in Dubai on that story. Jumana, why does Saudi want to sell these shares?
Well, let's just go back to what we know, which is that Bloomberg News are reporting that Saudi Arabia do want to go ahead with this secondary share offering of up to $10 billion. They're looking to raise $10 billion. It could launch as soon as Sunday, and the book building process will go on throughout the week next week. Though, of course, at this point, it is unclear what the terms of the share offering are going to look like. Sources that we've spoken to have told us that they could go for as much as a 10% discount to where the shares are trading currently, around 29 riyals. So that's something to bear in mind. But to go back to your original question, Lizzie, I think all of this is part and parcel of the Crown Prince MBS's plans to raise funding and look to invest those funds into other parts of the Saudi Arabian economy that are not hydrocarbon driven. So this is part of their so-called diversification plan. The funds will be used to invest in their tourism projects, that NEOM project that people talk about, although the size of the mega project is $1.5 trillion. So this is just a drop in the ocean if you think about $10 billion, and all of the other initiatives that they've been engaging in as well. So it is very much part and parcel of the Saudi 2030 vision. One thing I would say about the stock is Aramco's share price itself has underperformed the Tadawul this year. It's down about 11%. And this is a signal that many investors within the region and outside the region had been anticipating a further secondary offering, which explains some of the underperformance this year, in addition to, of course, the fact that oil production out of Saudi Arabia has been low and Aramco is the main state-owned oil company.
Yeah, shares at their lowest in more than a year yesterday. I also want to get the latest from you, Jemana, on the geopolitics, of course. We have heard from Israel's national security advisor saying that Israel probably won't defeat Hamas and the Islamic Jihad until the end of the year at least. I wonder, as this continues, you've got US pressure seemingly doing nothing. Is Israel out of control at this point?
I think those comments from Israel's national security advisor were pretty telling yesterday. In their eyes, they need to finish the job that they started. And the direct quote from that same national security advisor is that it will take them another 7 months to fully destroy the governmental and military capabilities of Hamas and the Islamic Jihad. They have estimated that so far 15,000 Hamas officials have been killed. Another 8,000 still remain in the city of Rafah, according to those Israeli officials. But it is worth noting that the offensive in Rafah continues. Yesterday, we talked about those tanks moving towards the center of the city. In addition to that, yesterday, Israel officials managed to secure that Philadelphia corridor. That is the corridor that separates Egypt from Rafah. It's about 14 kilometers long. They said that they have located about 20 tunnels running under the border. So the offensive into Rafah is still very much continuing. This despite the international condemnation that came through over the weekend after the attack on the encampment. Many European leaders, the likes of President Macron, are actively calling for a ceasefire. And then, of course, the backdrop is a potential hope for renegotiations of these truce deal discussions. The White House saying yesterday that a fresh proposal has been offered, although as far as Egypt and Qatar are concerned, so long as Israel still have troops on the ground in Rafah, it's going to be very difficult to continue moving forwards with those truce deal discussions. But the White House seems to think that there is a fresh proposal on the table. So that is the latest.
OK, Jemana Basechi, we thank you for that update on the Middle East. And don't forget to tune in to her show, Horizons, every day at 5 a.m. London time. Just staying in the Middle East, President Xi Jinping is meeting Arab leaders as China seeks deeper ties in the region. The Chinese president is going to address heads of state from Egypt, the UAE, Bahrain and Tunisia during this forum in Beijing. And discussions are set to focus on trade, investment and regional security concerns amid that Israel-Hamas war.
China firmly supports the establishment of an independent state of Palestine. On top of the previous 100 million yuan RMB of emergency humanitarian assistance, China will provide an additional 500 million RMB yuan of assistance to help ease the humanitarian crisis in Gaza and support post-conflict reconstruction.
So that was President Xi Jinping speaking at the China-Arab Forum. Coming up, after a 5-week battle, BHP abandons its $49 billion bid for Anglo-American. And we're going to discuss what that means for mining's biggest names. So stay with us for that next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. To M&A now, or not. After a 5-week battle, BHP has abandoned its $49 billion bid for Anglo-American, the Australian commodities giant walking away, for now, from what would have been the biggest mining deal in over a decade. And we can get more now from Bloomberg's Martin Ritchie. Martin, just talk us through the main issues that stopped this deal getting over the line.
The big issue was that Anglo, its management, did not want to talk to BHP. So for 5 weeks, we've seen BHP, the world's biggest miner, repeatedly make higher bids to try and engineer this takeover to create a global copper giant. But Anglo's management said, sorry, we don't really like your price or your proposal, which was very complex, and we're not going to talk about it. So at the end, by yesterday, there was a UK deadline for takeover, a formal takeover offer to be met. Anglo still wasn't talking, so BHP said, OK, we're not going to go ahead with this.
So is that it, or do you reckon that BHP is going to come knocking again in another 6 months?
Yeah, so the 6 months you refer to there is under UK takeover rules, BHP now has to not make any other further approaches for another 6 months. It's possible that they come back again. They do more work to try and firm up exactly what their proposal is, and they come back with another deal. That would be later this year or into next year. That's possible. In the meantime, Anglo has to press ahead with its own radical restructuring plan that it unveiled as BHP was trying to engineer the takeover. Anglo is going to split up its company, sell off some big assets to focus on copper and iron ore. With that in mind, in the future, BHP might well face more competition to buy Anglo. You know, there might be other miners that, having seen what BHP's done, come back and say, well, we want to fight for this as well. Rio Tinto's one option, Glencore is another.
Well, because you kind of wondered when they came out with that restructuring plan whether it was a sign that they were open to this BHP deal. Do you deduce from the fact that they've got this plan that actually Anglo could be open to one of those other suitors?
Well, certainly, it was the complexity of the proposal, or complexity of any merger with Anglo or takeover of Anglo, which was at stake here. Look. Anglo's a very complicated business with lots of different companies, its own stakes in other units in South Africa. So both BHP and Anglo recognise this. Anglo's restructuring proposal will see it sell off those assets, the platinum business, the iron ore business, so it becomes a simpler company. Also means that it becomes a simpler company for others to take over in future. That's why I'm saying there's a possibility of a bigger takeover battle in the future, perhaps into next year or beyond.
All right, it ain't over yet to anyone who's disappointed. Martin Ritchie in Shanghai, we thank you for the latest on that. It would have been mining's biggest deal in a decade, so we've got to talk about commodities. Let's check in on where we're at the moment. You'd seen a rally in copper and iron ore prices while the deal was on the table. Currently, copper 1.4% down there. You can see iron ore lower 2.6%. Demand, of course, constrained as China's sought to cap crude steel production. But a bright spot among the base metals, aluminium. It's been at a 2-year high. China, of course, the biggest producer, so aluminium benefiting from tighter Chinese capacity models. Prices up about 20% this quarter alone. And Brent there as well, $83 a barrel, down on this risk-off mood that we've been discussing all morning after that weak treasuries sale. That kind of offsetting the Middle East geopolitical tensions as we head towards the OPEC Plus meeting on Sunday. Coming up on the programme, ahead of a baked-in rate cut from the ECB in the June meeting next week, German inflation edges up for a second month. Does it throw a spanner in the works? We'll ask Oliver Crook next with a look to the euro area economy. So stay with us for that conversation. It's coming up next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Asian stocks and bonds under pressure after another weak sale of treasuries drags down Wall Street. The Fed's Beige Book points to modest growth in the US economy. Saudi Arabia is set to launch a $10 billion share offering in oil giant Aramco. Informal interest is set to already exceed the offer amount. Plus, deal abandoned. BHP walks away from its bid for Anglo American, leaving the world's biggest miner to look elsewhere to expand its copper production. Those are your headlines this morning. Now to the markets. We, as I say, have had another weak Treasury auction, raising concern that swelling supply could drive yields up even more just when the Fed is in no hurry to cut rates. And this has knocked stocks, and you can see futures on both sides of the pond here pointing to a lower opening this morning. S&P futures down 0.6%, Euro Stoxx 50 futures down 0.4%. We had that German inflation data yesterday, potentially muddying the waters for the ECB. We'll discuss in a moment with Oliver Crook. But if we flip over to the cross-asset picture, you can really see the impact of the Treasury auction on yields. 4.97 is where we are on the 2-year. And it did lean that you had the dollar driven higher at the expense of Asian currencies as well. Could we see 160 for dollar yen before the year is out? Brent at $83 a barrel, a touch weaker as we head towards that OPEC Plus meeting at the weekend. And you've got gold there also weaker by 0.3% at $2,330 an ounce. But we can dig deeper into that Treasury auction and its effects rippling across the global markets now. The Fed Beige Book also implying that stagflation is percolating, although Atlanta Fed President Raphael Bostic says he's hopeful the explosive price pressures of the pandemic are going to normalise over the next year. Well, let's dig into it with our MLive strategist, Mary Nicola. Mary, just looking at the effects of all this, we saw the slide in bonds dragging down on stocks, but do you actually reckon we'll see a little dip buying now?
There's clearly a lot of angst heading into PCE on Friday, and so that's what you're seeing in the markets where Treasury yields are grinding higher and the demand for the Treasury auction has been quite tepid. So that combination, especially of what PCE can tell us, and does it really price out, 2 Fed rate cuts for this year that the market is currently looking for. So all of this is keeping investors on the sidelines and pushing bond yields higher as well. So it's really the clarity from PCE that we're going to get. But once we get that clarity from PCE, then the next focal point will be on the jobs market and how jobs is heading, and of course, are the data showing that that in fact activity is softening while prices remain resilient, and that will weigh on equities even more.
So you mentioned we've got the May jobs report on June the 7th, CPI on June the 12th. Do we see dollar strength all the way till then?
Yeah, it's very much data dependent until then, but at the same time, so any downside surprises is likely going to pressure the dollar a lot lower, while any upside surprises is going to keep the resilience of the dollar. So unfortunately, it's hard to tell the exact trajectory because everything is so data dependent. And then, of course, the markets are going to reprice where the Fed is headed. So far, with the data that we do have, it looks like that the dollar is going to stay strong because we're not seeing as many cracks on inflation as you would like to see if the easing cycle is going to commence.
And we're just showing on screen there the impact of the dollar strength on the yen, the weakness continuing. And yet you've had all of this pressure from G7 nations not to do another yen intervention, whether or not we already had one or two. But is it that another yen intervention is out of bounds at this point?
Well, it looks last time they intervened or suspected intervention came through was when dollar yen hit 160. Now, if we see a gradual rise towards 160, we may see a revisit of the same sort of operation again that comes through. So the focus is still on dollar yen, but we also have to look at where euro yen is and sterling yen. And it looks like a lot of the positioning is and the yen bearishness is just being rerouted elsewhere because of the focus on dollar yen so much. So even if dollar yen continues its slow grind higher, the pressure on the crosses is going to continue.
Yeah, interesting that sterling yen cross, not one that we often talk about, but historic this week. Bloomberg's MLive strategist Mary Nicola, good to talk to you on that. And just continuing our thoughts on inflation, as of course we look ahead to PCE tomorrow, but we've already had a surprise out of Germany this week. Inflation edging up for a second month, potentially throwing a spanner in the works for the ECB, really underscoring its challenge in achieving its 2% target as it prepares to lower rates next week. A decision well telegraphed, but Bloomberg's Oliver Crook can join us for the very latest on, Ollie, where this data fits into the inflation picture.
Yeah, Lizzie, let's just get into the German number that we got yesterday, because coming in at 2.8% is really not the direction of travel the ECB wants to be seeing in Germany and really in the Eurozone. That is the second tick up. It is much higher, or say 20 basis points higher than what economists had estimated. But listen, I'm going to try to give some little bit of a rosy picture on that. There's some of the base effect there because they brought in the 49 euro ticket, this huge public transport subsidy a year ago. So that helped sort of boost things up a little bit in contrast. And when we're expecting across the board here in Europe is something similar, year-on-year numbers that are going to be ticking higher in Spain, in France, and across the Eurozone. We're also going to see a deceleration of the coming down of the core inflation data as well, which is not, again, encouraging. But here's the silver lining. If you actually look at the month-on-month figures, not the year-on-year figures, basically across the board, it's at 0.2%. So if you can hold that steady, that's an annualized rate of 2.4%. That's more or less in keeping with what the ECB is trying to do.
And so where does it leave the ECB for its meeting?
So listen, we all know that it's a June cut, then what? That is the big question, and that is where the debate gets sort of interesting. And we've had a huge amount of commentary from ECB members throughout the week. Let's start with Joachim Nagel, the president of the Bundesbank, who spoke to us just a little bit earlier this week. Have a listen.
What did we really write over the last 2 years is that we really followed the meeting to meeting here, understanding, and I believe that should still be the case. So if there's a rate cut in June, we have to wait, and I believe we have to wait till maybe September, I think July. But as I said, it is too early to speculate.
So you have Nagel there saying that basically, September is maybe when you see the next cut. And let's see some of the commentary we got from some of the other governing council members throughout the week. Holtzmann saying basically there are no automatic moves on the table. Everything is going to go meeting to meeting. Philip Lane saying that we need to be restrictive until the rest of the year, and the pace of cuts will be determined by the data. Something very similar from Klaus Knot. The only sort of dove in the room over the last couple of days is coming out of France. Villeroy saying do not rule out a July cut. So I think overall for the ECB, the inflation picture is intact. It is coming down. The question is at what pace and how durable is it? And that should make the next few meetings pretty interesting for you, Lizzie.
Yeah, exactly. The press conference at this meeting will be interesting if we get any clear guidance from Christine Lagarde. Villeroy keeping it spicy for us. Bloomberg's Oliver Crook, we thank you for that update on how the German data feeds in to the ECB's thinking over the next few meetings. Now, let's turn to some of the other stories making news this morning. Bloomberg has learned that the European Central Bank is set to impose unprecedented fines on several lenders after they failed to progress enough in addressing the impact of climate change. As many as 4 banks face penalties after not meeting deadlines for assessing their exposure to climate risks, and those fines per day can technically be up to 5% of daily revenue. Elsewhere, the Bank of France Governor François Villeroy de Gallo says that the European Union should delay implementing new bank capital rules if the US is seen as doing the same. Many banks are concerned that they could be put at a disadvantage and face penalties if they bring in the rules more quickly or more stringently than others around the world. And in other news, Goldman veteran Beth Hammock has been named by the Cleveland Fed to replace Loretta Mester. This is from August. Hammock worked at Goldman Sachs from 1993 until stepping down earlier this year, and she'll follow Mester, who's retiring at the end of June after a decade as the president of the Cleveland Fed. Well, we're going to be speaking later in the programme about tech here in the UK and the general election. We'll talk to the founder and CEO of Buy Now Pay Later platform Zilch. So that conversation is coming up next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now to some top stories making news in the space of tech today. HP shares gained in late trade after it reported quarterly revenue that topped analysts' estimates, including its first increase in PC sales in 2 years. Revenue from HP's computer unit increased 3% in the second quarter, and the jump was due to a rise in commercial sales, while consumer sales did continue to decline. In other tech news, Salesforce shares slumped after the bell as the software maker warned that sales growth in the current quarter would stall to the slowest in its history. It sees revenue rising only as much as 8% in the current period, which is fueling concerns about its ability to stay relevant as the industry moves towards AI tools. Now, here in the UK, the tech sector has been warning that it risks falling behind, with many of its success stories increasingly choosing to list abroad. One company that's considering an IPO is the British buy now, pay later platform Zilch. Now, ahead of the summer election on July the 4th, I'm pleased to say I'm joined by the CEO and co-founder of Zilch, Philip Belamant. Philip, lovely to have you in the studio with me. It's interesting, you're working on making the UK a bigger hub for financial innovation. You're part of Innovate Finance's Unicorn Council. I wonder, whatever government we have next, whatever colour they are, what do they need to do to make it more attractive?
Well, what's interesting is, I think it's about now 5 weeks to the day, we are all going to discover who's in the seat. And what's really interesting is that it doesn't matter who that is, they are going to inherit a $1 trillion technology sector. That's the third largest on the planet, right? And part of that, a major part of that, is fintech. So companies like Zilch are really going to be very critical to the growth of the economy moving forward. And we really need to see whoever is in the seat leaning into businesses like Zilch and their peers, making sure they can continue to grow and thrive here in the UK. And ensuring ultimately that we see that economic growth that's going to drive the country forward. And certainly we're excited about the fact that conversations with both parties are certainly going that direction. Everyone seems pro-business. People are certainly very supportive of Unicorn Council and the types of policy that we're calling for. And that's the last thing I will say on this is we are certainly calling for clarity on policy. That is what's going to drive this.
Well, I hope we're going to get some in the coming days and weeks with the manifestos dropping. I hear that the Labour leader, Keir Starmer, has been having breakfast with every CEO in the city. Has Labour rolled out the red carpet for you?
Absolutely. I mean, I keep saying this, we are seeing this on both sides. So both parties are really leaning in. And across the spectrum, we're having numerous conversations that are very productive around policy, how we drive things forward. And with the Unicorn Council, which we co-founded with Innovate Finance, as you mentioned, we now have 50 billion of market cap companies in that council. If you think of it this way, that could be 50 billion of listings coming to the LSE. That would be FTSE 100 companies. And so when we talk about policy, we've refined the list of all of these companies' asks to about 5 major points so that we can communicate this succinctly to Downing Street and policymakers. And those are across things like, for instance, entrepreneurs relief, EMI, VAT, R&D, and stamp duty. And the whole idea here is let's remove any excuse for the stakeholders here in the UK to invest in the economic growth of the country. Let's just get rid of those excuses. And what I mean by that is if you think about things like pension funds, are they buying and holding British stocks? Just 30 years ago, almost 50% of pension money was in British companies. Today, it's less than 5%. How do we change that? And at the same time, how do we get retail investors to buy and hold British stocks? I'm sure you know this today. You can buy and hold a Tesla share as a retail investor for free. But a Rolls-Royce share is going to cost you stamp duty. Why is that the case?
OK, well, the polls suggest that Labour are going to be the next government. You say you've spoken to both the parties, but you can tell me whether they're coming through on these demands by answering my next question. Are you going to do your IPO in London over New York?
Well, that's a great question. Our shareholders would love to talk to you about that too.
Break some news for us.
Exactly. I mean, look, we've always said, and you mentioned this earlier, we're a big advocate for companies building the business here, growing here, staying here, listing here. And we'd certainly love to see that happen. There are certain things that need to be done, and we're in conversation with the LSE. Again, the LSE is leaning in to all of these companies and saying, tell us, what do you need to see? Of course, we need to see liquidity. We need to see policies to help drive that liquidity. We need to see interest rates starting to come down so we can drive capital back to equities. They need to start working a bit harder for the yield, and that'll open markets back up. And if we can then get policy in place to have pension funds buying and holding British stocks at scale, we can get retail investors buying and holding British stocks, you start to get an environment where we've removed all excuses for companies not to list here. So, that's the way we're thinking about it. If we can get these things right, I'm not sure why companies wouldn't consider very strongly listing here.
Well, the pension funds point is a controversial one. Do you think that it should be mandatory that they should hold a certain amount of British assets?
I'm not sure it's easy to make it mandatory. The UK naturally is a very international scene when it comes to investment. If you look at the US, a lot of the money is domestic capital. So I don't think we want to kill that culture here. We want international capital here in the UK. And mandating a portion of this from pension funds may somewhat stifle that. What we need is policy that creates the right behavior from pension funds. How are they being measured? Is it on the cost of investment? Or is it on the return of their investments they're making? And if we tweak this, we might see that the behavior changes to chase down yield, real yield, rather than just the cost of making those investments and being very protective. So I think mandating a portion is quite difficult, but there are policies that could be put in place to drive this agenda.
Yeah, but of course that's not the only policy that affects you. It's also the regulation of the buy now, pay later industry. What do you want to see there from the next government?
We've said this numerous times today. Zilch is one of the only providers in the space that is fully regulated as we stand here. And, we've proven time and time again that it is possible to run a business like this at a 50+% gross profit margin being fully regulated. This is possible. So we would be calling on whoever is in the seat in 5 weeks' time, regulate BNPL within the first 100 days. Let's just get this right. We need to protect consumers. We need to remove the confusion and continue driving customers to this phenomenal way of paying over time and not being rolled into high interest rate credit cards.
And you've kind of benefited from the cost of living crisis, people wanting buy now, pay later products because they've been squeezed financially. As the inflation pressures ease off, does that become an issue for you?
Not necessarily. I mean, what we are seeing in the market is the cost of living is tough for everybody. Obviously, that does drive demand. But interestingly, customer behavior, isn't always how it would seem in theory. People actually tighten up their belts. They stop spending as much. What we are seeing is customers are spending the same, if not slightly more, but they're buying less items for that same amount. So naturally, you're seeing inflation come through in the numbers, and people are struggling to start to afford the day-to-day items that they need to buy. So whilst you could argue it's been somewhat of a tailwind, we also have to be very conscious of, are we over-lending? Are we lending responsibly? Can people actually afford this? So it's a very fine balance. We are very aligned with our customers. And this is why we provide both a debit and credit proposition. What we are saying is, don't use more credit. Come to Zilch and get deals, discounts, deep discounts, and use debit for the day-to-day spending. And where you need a bit more time, use the credit proposition, but never pay any interest. So the combination of these things really helps the customer.
OK, it's interesting that the spending patterns are changing, but as you say, demand for Zilch keeping on. All right, Zilch CEO and co-founder Philip Belamant, lovely to have you in the studio with me. Kind of an economic barometer, somewhat, your data too. And you can catch our interview with the Director General of the British Chambers of Commerce on all of this conversation about the UK election and what it means for businesses coming up at 9:30 a.m. on The Pulse. That's with Francine Lacroix later this morning. Lovely to have Philip, though, on the tech implications, and we'll have plenty more conversations coming up on the programme next. This is Bloomberg.
They have not been stress tested. You know, do people really fully understand what I said about interest rates affecting what these things are worth? Do they? And if a little old lady finds out that she can't get her money back, and there may have been disclosure there saying, you know, this money's locked up for 5 years, but you know what? Retail clients tend to circle the block and call their senators and congressmen, and they could be held to pay.
The JP Morgan CEO, Jamie Dimon, there with a warning on private credit. You've got to ask how long this private credit boom can last, with the likes of Dimon trying to stage a comeback and, of course, with central bankers talking about a pivot. But let's take a look at some of the data that will inform when that pivot will happen. Courtesy of the Fed's Beige Book, you can see the slowdown in business sentiment across most districts here. And we now need to look towards the NFP report next Friday, just ahead of the Fed meeting. Will we see this sort of feeling feeding into that? The Boston Fed reporting weaker labour demand, the Dallas Fed reporting some hiring reluctance as well. If we flip over, next up is the second reading of first quarter GDP in the US, the expectation being for a reading of 1.3%, a slowdown. And this is because, as you can see here, drags on net exports and private inventories as well, the red and the purple bars there. So those are the data points coming up, but we've got a big interview coming up for you later in the programmes. It's the chairman of SocGen. That's at 9 a.m. UK time. Don't miss it on The Pulse with Francine Lacroix. But up next, it's Markets Today with Kriti Gupta and Guy Johnson. This is Bloomberg.